Hi there and welcome back. I hope you've enjoyed my previous webinars. This week we're going to talk about key financial metrics. How do we know if a property is a good deal and if we should proceed with the purchase? So how do we evaluate properties financially? When we look at a deal, we may like the location, we may like the property itself, but if the numbers don't make sense, we need to pass on the deal. So there's a few key metrics we need to pay attention to. We have net operating income, cash on cash return, cap rate, and debt service coverage ratio. This may sound a little technical, but moving forward, you'll make sure that you understand these key metrics and know how to evaluate your property. So the first one we need to look at is the net operating income, or NOI. It really measures the cash available by taking your income, subtracting your operating expenses, then you arrive at your NOI. It does not take into consideration any kind of debt service you have. So for example, if you have $100,000 annual income, so you take in $100,000 in rent, and you have $50,000 worth of expenses, excluding your capital expenses, which we'll talk about in a later webinar, you have $50,000 NOI. We also need to look at what's called the expense ratio. It's basically just your expenses divided by your income multiplied by 100. So again, in the previous example, $100,000 annual income, $50,000 expenses, you arrive at a 50% expense ratio. And large studies have shown that multifamily properties typically run at a 45 to 50% expense ratio. So if you see brokers saying that the expenses are 30% or 25%, that's probably an indication that you need to really look carefully at the numbers. So the other one, this is very important for people that invest in deals, is what is your cash on cash return? It essentially does mean what is the percentage return you earn on your investment. So let's say you have a $1 million purchase price, you pay down $250,000 as the down payment, 25%. Then you have $25,000 of annual income after expenses and debt. And using that formula, you take the annual income divided by the amount of money you spend, multiply it by 100, and you get a 10% cash on cash return. So that's basically you get $25,000 return on your $250,000 investment. So again, is 10% good or bad? That's really up to you as an investor to understand. You know, if you go and put money into a CD in the bank, you may earn 2%. The stock market maybe 6-7%. So if you can get 10%, I would be very happy with that. It's difficult to return that kind of numbers in today's market, though. The other measurement we have is the capitalization rate. It's basically a ratio on the purchase price and the net operating income. And a cap rate is similar for the same class property in a given market. And it's just a way to compare two properties. If property A has a cap rate of 7 and property B has a cap rate of 8, you know that as a buyer, it's better to buy the one with a higher cap rate. We also need to consider that cap rate does not consider debt service. So again, a cap rate in percentage is basically the purchase price divided by the NOI multiplied by 100. So again, here's an example. We have a $1 million purchase price. We have $75,000 NOI, so that's our income after all expenses. So we take $75,000 divided by $1 million and multiply by 100, and we arrive at 7.5% cap rate. We can also estimate what the value should be based upon a cap rate and an NOI. If you know that the market cap rate is around 6, a certain property is returning $50,000 in net operating income, you take the 50,000 divided by 0.06, so 6%, and you get a value of 833,000. So again, that's a quick way to see what is the value of a certain property. Another important measurement, and this is one the bank is going to look at, is what's called debt service coverage ratio. This is basically how well the property income can cover the debt payments. Banks typically want to see 1.25 or higher debt service coverage ratio. So here's another example, and I apologize, all these math may be tough to follow, but you can reach out and I can explain in more detail if you need to. So an example here, we have $75,000 of net operating income. This again is your income less your expenses. And you have, but that's $75,000 net operating income, you have a $50,000 debt service. Then you need to divide your NOI with your debt service and debt service principal interest, and you arrive at a 1.5 debt service coverage ratio, seeing that your income can cover the debt easily. So that's good. The bank will be happy for that. Here's another example. You have $50,000 of net operating income, $45,000 of debt service, and this is all annual numbers. You arrive at a 1.1 debt service coverage ratio. That's not so good because there's very little margin for error here before your debt service will be higher than your net operating income. More vacancies, lower rent, and everything else. So this is a very important number and something the bank is going to look very carefully at. So again, hopefully you enjoyed this quick webinar talking about key financial metrics. If you're interested, I'll be very happy to get on a call with you. Just go to opendoorscapital.com/call and we can set up a free call. Next week, we're going to talk about selecting and evaluating market. Until then, have a great day.